Thanks very much, Michael, for the very kind introduction. And just to say, it's fantastic to be here today with you all. So as Michael said, I'm going to talk a bit about why monetary policymakers are increasingly thinking about the impact of climate change. So let me kind of begin by saying that we're used to thinking of climate change, I think, as something that happens in the long run. And for monetary policymakers, obviously, the focus is predominantly on responding to the shorter-term dynamics of the economy in order to achieve our inflation target. So why am I here today to talk about this subject? Well, let me start by saying central banks have been assessing the financial stability risks from climate change for a decade or more. The former governor of the Bank of England, now Prime Minister of Canada, Mark Carney, gave a speech in September 2015 on the impact of climate change on financial stability. Then in 2019, the Bank of England set supervisory expectations for banks and insurers. And in 2020, my colleague, Sarah Breeden, led the development of the first vintage of climate scenarios at the Network for Greening the Financial System. All of this work established the case that climate's a risk to the financial system. In 2021, central banks turned to focus on the risk from climate change to their own balance sheets and to monetary policy operations such as asset purchases. Sabine Maudra, who's now chair of the NGFS, led work to explore how monetary operations might need to adapt to a hotter world. And the Bank of England also set out to green our corporate bond purchase scheme. But assessing the implications of climate change for monetary policy is a relatively newer line of inquiry. The ECB's Isabel Schnabel explored this issue in a speech in 2022. And in 2023, my colleague, Catherine Mann, who's a member of our Monetary Policy Committee, expressed the view that monetary policymakers could not ignore the effects of climate change. So why is the focus increasing? As Michael said in his introduction, this can be a controversial question, but actually I think the answer is really simple. Monetary policymakers need to take account of any macro-relevant shock, which occurs over the monetary policy horizon, typically thought of as the next 2 to 3 years. And the most difficult shocks to deal with are those which push inflation and output in different directions, so-called trade-off inducing shocks. And there's evidence that the impact of climate change is increasingly exhibiting these characteristics. So before I go into that, let me make 3 introductory points. First, as central banks, we take the scientific evidence on climate change as given. We're only interested in how it affects the economy and the financial system. Second, the policies needed to mitigate climate change are for governments, not central banks, to decide. But while we take those policies as given, they will have economic impacts. And where there's uncertainty about the path of those policies, that will also affect economic behavior. Third, this isn't about whether central banks should change their remits in response to climate change, not least because different central banks have different mandates. The Bank of England's monetary policy remit is set by the government, and it's clear that price stability is our primary goal. But subject to that, we support the economic objectives of the government. However, I think the key thing that unites all central banks is that if climate change or the policies enacted to mitigate it affect economic outcomes, it's a relevant consideration, just like any other economic shock. So let me start with the scientific evidence. The IPCC estimates that average global temperatures are now more than 1 degree higher than pre-industrial levels and are set to rise at 0.2 degrees Celsius per decade due to past and ongoing greenhouse gas emissions. Last year was the warmest year on record, with average global temperatures exceeding 1.5 degrees above pre-industrial levels. And as climate change has accelerated, the frequency and intensity of extreme weather events has increased. And even small increases in global temperatures are expected to have significant impacts in future. Annual global damages from weather-related hazards have more than doubled in real terms in the last 20 years. Last year alone, natural catastrophes resulted in global economic losses of over $300 billion. And according to the Swiss Re Institute, annual insured losses for natural catastrophes have been growing at between 5 to 7% per year for the last 3 decades. And that trend is set to continue. There's also evidence that we're already seeing macroeconomically relevant impacts from a changing climate. Even countries like the UK, which may be less susceptible to these shocks, can be affected by events abroad. International food commodity prices are one example, as noted by Governor Andrew Bailey in a recent speech. A study by Gert Peersman shows how unanticipated increases in global food commodity prices have reduced output and increased inflation in advanced economies. At the same time, governments around the world are implementing policies to transition to a less carbon-intensive economy. in order to prevent the large and longer-term damages from a changing climate. Just under a quarter of global greenhouse gas emissions are currently covered by some form of carbon pricing mechanism, which aims to internalize the negative externalities created by those emissions. In the UK and the EU, the price of carbon in the emission trading system has been rising and is set to rise further over the next 3 years. Sectoral coverage is expanding, new carbon-intensive import taxes are being introduced, and both the supply of permits and the share given for free are being cut. In short, the impact of climate change is becoming a macroeconomically relevant shock over the monetary policy horizon, as well as affecting our societies and economies in the longer term. And in light of that, over the past 3 years, members of the Network for Greening the Financial System have come together to develop a framework and an analytical foundation to model and understand the impact of climate change on the economy. At the Bank of England too, we've been developing our toolkit to understand the impact of climate change on the UK. The final thing I want to emphasize by way of introduction is that while the climate transition might seem like a problem for monetary policy, the no transition scenario looks much worse. There's no better illustration of this than in the latest NGFS scenarios, which show that while policies to tackle climate change may present an inflation output trade-off for monetary policy to deal with, the economic costs of climate inaction would be far worse. And that would be a far worse shock to deal with further ahead. Losses from the chronic impacts of climate change without further policy action are expected to be close to 15% of global GDP by 2050, relative to a theoretical baseline of no climate change. That's about 2/3 greater than the combined losses from physical and transition risks under a scenario where we reach net zero in 2050. So in the rest of this talk, I'll talk about the work of the NGFS and the Bank of England to better understand the macro impacts of climate change before turning to how monetary policymakers might factor these changes into decision-making. And I'll finish by giving some current and proposed examples of how we might operationalize that. So let me start by thinking about how we assess the impact of physical risks on the economy. Here, I think there are at least 3 dimensions. First, the nature and the type of the physical hazard. Second, the level of activity at the location where the shock occurs. And third, the vulnerability of assets and economic activity to these physical events. Here, adaptation measures, for example, building flood barriers, are vital to increase resilience to these severe weather events. So what matters to monetary policy is how demand and supply are affected over the monetary policy horizon. So starting with supply, there can be immediate destruction of physical goods, capital and infrastructure, as well as displacement of workers. Bank of England research looked at the impact of flooding on UK firms from 2011 to 2021, and it found a significant increase in the probability of business termination as a result of a flooding event for both small and medium-sized firms. Productivity may also fall given the impact of physical hazards on labour and agricultural land, or via diversion of attention and resources to reconstruction efforts. For example, heat waves may reduce manufacturing productivity. A drought will often impact agricultural productivity. Business relocation in response to a chronic increase in the exposure to physical risk can also have a significant impact. Severe weather events can also negatively impact the demand side of the economy too in the near term. Destruction and loss of assets will impact income and wealth, which puts downward pressure on consumption. These effects come through a variety of channels, including the destruction of housing and the disruption of wage payments or business income, as well as greater uncertainty about growth and income prospects. There are also financial channels which can amplify these effects. Asset prices may fall because of the current or expected destruction of physical assets. And there's a lot of evidence to suggest that house prices are negatively affected by current or expected physical hazards. So the value of collateral that borrowers can pledge to secure a loan can fall. Reduced insurance availability could also put downward pressure on house prices. And in addition, if banks' balance sheets are adversely affected, this can affect their willingness and ability to lend. The overall impact on output and inflation will depend on how supply and demand are affected and also the response of monetary policy. Econometric studies on the macroeconomic impacts from severe weather events find that the growth rate of GDP drops on average by around 0.5 percentage point in the immediate aftermath of a severe weather event. An older study by Redatz estimated that a climate-related disaster resulted in a cumulative per capita output loss of 1/4, 1/2, and 1% for high, middle, and low-income countries, respectively. And this brings out a point that countries with a lower resilience threshold also tend to see bigger effects. DeWin and Pearsman showed that a 10% increase in global food commodity prices stemming from weather-related shocks lowers GDP by 0.5% after 6 quarters across a panel of 75 countries. Adaptation measures and effective insurance can limit the economic fallout from severe weather events. Faster payouts from insurers can help to speed up the recovery and help to limit the reduction in consumption. But research suggests that 55% of global losses from physical hazards are currently not insured, and that, of course, may rise in future. A government's ability and willingness to provide fiscal support is another important determinant of economic outcomes. Indeed, more frequent and severe weather events can diminish fiscal capacity and impair insurance provision, which can further increase the impact of shocks. The inflation impact depends on the type of disaster and the composition of the economy. A paper by Miles Parker draws a distinction between storms, which increase food price inflation, and floods, which increase headline inflation more broadly. The study I mentioned earlier by Gert Pearsman showed that in response to a 1% unanticipated increase in globally traded food prices, euro area real GDP declined by 0.1% and headline inflation rose by 0.1%. And our own work at the Bank of England suggests similar results for the UK. These impacts seem set to increase further as shocks become more frequent and severe. A 2023 paper by Kotz et al. Found that the summer 22 extreme heat caused a cumulative impact of 0.7 percentage points on annual food price inflation and 0.3 percentage points on annual headline inflation in Europe. That paper also presents future scenarios where the impact on inflation will increase substantially. A paper that was published a couple of weeks ago by Fakara and Mari showed that a 1 standard deviation increase in the number of UK floods would reduce regional output in the UK by 1% and raise regional inflation by 0.5% at the 2-year horizon. In light of all that, I think it's little wonder that governments have turned their attention to reducing the risks associated with climate change. But of course, those actions will have an economic impact too, so let me turn to that next. The shift towards a lower carbon economy will affect how firms produce, how households consume, how governments spend and raise taxes, how banks and investors allocate finance, and it can also have international spillover effects too. For ease, let me focus on 2 types of transition policy. The first is carbon pricing, and the second is government subsidies or investment. The aggregate macro impacts of these policies will vary according to their design, pace, stringency, credibility, and the degree of coordination across countries. In the short run, higher carbon prices can act as a negative supply shock, leading to an increase in inflation and a fall in output. Over the medium and longer term, the overall macroeconomic impacts will depend on policy design, sectoral coverage, and how tax revenues are spent. A gradual and predictable rise in the carbon price results in smaller increases in inflation. Conversely, a more rapid price increase due to a delayed transition could create greater volatility, requiring central banks to act by more. The macro impacts of green subsidy schemes will depend on their design and how they're financed, as well as any supply bottlenecks. Directly subsidizing private investments in green sectors can act as a positive demand shock, whereas subsidizing the price of green inputs can look more like a positive supply shock, increasing output but reducing inflation. And the effect on overall inflation in the medium term will depend on the impact on inflation expectations and the reaction of monetary policy. At the bank, we've been thinking about how these sorts of policies affect the UK, and let me talk about some of that work. First, the impact on business investment. A net zero consistent pathway for the UK requires average financing of around £37 billion per year between 2030 and 2050, according to estimates by the Climate Change Committee. Indeed, evidence from the Bank of England's decision maker panel suggests that climate policies are already impacting the behaviour of UK firms. In 2024, for example, UK firms reported that climate-related investments were set to rise from 2.5% of capital expenditures to 5.5% in the next 3 years. Larger firms and those with higher energy intensity production expected the highest investment. Second, the impact on growth and inflation. Using a structural model, bank colleagues find that increases in carbon prices in the emissions trading system push up on inflation and down on output in both the UK and the euro area. The UK model estimates that over the period 2008 to 24, a 10% carbon price increase triggers an immediate rise in energy price inflation of 0.8 percentage points. And that's followed by a smaller but more persistent rise in non-energy price inflation of around 0.15 percentage points at its peak. And that suggests pass-through to energy-intensive sectors from the initial shock. There's also a lagged and temporary fall in the level of GDP in the model. Now, while a shock of this magnitude is illustrative, these dynamics suggest that when viewed in isolation, policies to increase the price of carbon operate much like other supply-side shocks in the economy. Although, of course, the models we're using here don't capture the offsetting positive impact of avoided physical damages. Over the next few years, in other words, the current monetary policy horizon, the impact of carbon pricing on the economy could intensify. ETS sectoral coverage is set to expand, and as free allocations are phased out for other sectors, carbon price rises could exert more direct upward pressure on headline inflation. The third piece of work is on spillover effects from abroad. Bank researchers have examined the potential spillover effects to the UK of carbon pricing and green subsidy policies implemented by major trading partners, using a two-country, two-sector DSGE model. The analysis suggests that an increase in green subsidies abroad is expansionary for the UK, because UK production expands to meet rising trading partner demand for UK exports. The model suggests UK inflation initially falls due to cheaper imports, though it eventually rises alongside higher UK economic activity. Conversely, increasing carbon prices abroad pushes up on UK inflation as imports become more expensive, while UK green goods exporters might benefit from rising demand for their products. The contractionary effect on trading partner output gradually decreases the demand for UK exports, which lowers UK output. So for a small open economy like the UK, transition policies overseas seem to have similar economic effects to those at home. So let me talk next about the implications for monetary policymakers. The body of research and analysis that I've just discussed suggests that the impact of both the physical effects of climate and the climate transition are growing in size and may increasingly represent a trade-off inducing shock for monetary policymakers to deal with. So how should we think about this? Well, to answer this question, I'm going to adapt a framework from a speech given last year by the governor of the Banque de France. He considers 5 characteristics that are important for assessing how a climate shock or policy transmits through the economy. First, persistence. If a shock's temporary, the classic prescription for monetary policy is to look through the first round effects of a trade-off inducing shock. However, if natural disasters become more frequent and severe, it becomes harder to do that, not least because of the need for monetary policy to lean against the second round effect in order to keep inflation expectations anchored. Second, the size of the shock. Many studies have found that in the past, climate-related shocks have been relatively small. But these are likely to grow. The paper I mentioned earlier by Kotz et al. Shows that without adaptation measures, annual global food price inflation may increase by between 1 to 3 percentage points by 2035. And that would increase headline inflation by between 0.3 to 1.2 percentage points. Those sorts of numbers really would be monetary policy relevant. Third, if a shock affects sectors that are key nodes in the economy, it will have larger and more persistent effects. And there's evidence of this already. The 2022 droughts led to low water levels on the Rhine River in Germany, and that led to falls in industrial production in the same country. And that's because the river plays an important role in the transportation of raw materials that are the beginning of production chains, causing knock-on effects to finished goods. Fourth, the salience for households of affected sectors. Studies suggest that household inflation expectations are particularly influenced by price changes for items that they buy more frequently, such as food and energy, which are both particularly exposed to climate change. Fifth, the predictability of the shock. Natural disasters are, by their nature, of course, highly unpredictable, even if the increasing frequency of their occurrence is more certain. Transition policies that are clear and implemented gradually, like a carbon tax phased in over a number of years, are less likely to lead to sudden volatility in inflation and output. So in short, this sounds quite similar to the shocks that monetary policymakers have faced in recent years. Large, unpredictable, but persistent supply shocks in areas of salience for households, which in some cases have disrupted supply chains. Indeed, if this sounds like more of the same, then I would argue this is important for central banks in the context of our recent experience, not least because failure to act in response to these shocks could lead to second round effects, affecting wage bargaining and inflation expectations. There's ample evidence that at higher levels of inflation and as inflationary shocks occur more frequently, households and firms pay more attention to current inflation when forming their expectations. So as acute physical shocks occur more frequently, monetary policymakers will need to understand the economic impact of these shocks and may need to react to them in order to keep inflation expectations anchored. So let's look at some examples. For disaster-prone countries, it's clear that there's a trade-off between near-term inflation and falling output. In general, policymakers in these countries are more likely to tighten than relax monetary policy in response to these shocks. As physical events become more frequent and severe across a number of countries, the likelihood of second-round effects on inflation will increase, especially if agents start to incorporate expectations of future shocks. Turning to transition policy, some of my colleagues at the Bank of England used a climate DSGE model to look at how the announced future path for carbon pricing and green government spending policies might affect the UK economy. Importantly, the model assumes less than full anticipation of the policies to be implemented. In the medium run, these policies push down on output and up on inflation. In short, we have a classic trade-off again. Monetary policy is forced to tighten in the near term, a degree of restriction lessening further out because the negative effects on output begin to materialize. Modeling assumptions are really important though. First, this model includes none of the acute physical damages avoided in the longer term by transitioning the economy. Second, the overall impact will depend on exactly how the carbon tax is implemented and the way that the revenues are recycled back into the economy. And third, the model takes no view of the longer run effects on the supply side of the economy. Indeed, while the efficiency of the economy may be reduced in the near term as we phase out fossil fuels, if green technologies are more efficient in the long run, then productivity will rise further out. So where do we go from here? Well, as I noted at the beginning, we've been working on these issues over the past 3 years in the NGFS. And I think one of the strengths of that network is the diversity of its membership. This means that not only do we have a lot of central banks thinking about these issues, I think there were 105 at the last count, but more than 60 of those members have come together to set out the framework and an analytical foundation to model and understand the impact of climate change on the economy. Those central banks bring different skills and experiences. They span all 5 continents. They include oil exporters and importers, low income, emerging market and advanced economies, and countries where the physical effects of climate are already becoming much more prominent. More broadly, I think my main takeaway from this work is don't let the best be the enemy of the good. Get going on the modeling. While some central banks now have models which factor in climate considerations, the impact of the transition can be modeled using relatively conventional economic models, such as those used to assess the impact of taxes and subsidies. And we detailed a list of these models in the NGFS Macro Modeling Handbook, which we published last year. On the physical side, modeling remains more challenging, I think, because it requires the combination of 2 disciplines, economics and climate science. The most common approach to model physical economic impacts is to use integrated assessment models, which link an emissions pathway to macro impacts via the use of a damage function. These are more appropriate, though, for modeling more gradual chronic physical impacts. Indeed, damage functions are an active field of research with improvements being made over time. For example, this year's vintage of the NGFS long-term scenarios show much larger damages for chronic climate impacts than in previous vintages. Other models are also required to reflect acute physical factors to allow for these unanticipated higher frequency shocks. The next phase of the NGFS monetary policy work will build on this experience, and we're exploring how the impacts of climate change can be integrated into monetary policy decision-making. We're also conducting a modeling collaboration with the IMF using their global macroeconomic model for the energy transition. Indeed, some central banks have already embedded climate-related variables in their nowcasting and forecasting methods for GDP and inflation, whereas others are beginning to explore climate scenarios for monetary policy purposes. At the Bank of England, we've been developing our own capabilities to explore the transmission of climate shocks and to assess our forecast errors. For example, some analysis we've done suggests that climate transition policies were probably more important contributors to recent movements in inflation than we previously thought. More broadly, we've begun to act on the recommendations of the review by Ben Bernanke of forecasting for monetary policy making and communication at the Bank of England. As part of our response to this review, we plan to make more systematic use of scenarios for monetary policy, which was described in a speech last year by my colleague Claire Lombardelli. That can include weather and energy-related scenarios where appropriate. And such scenarios would sit alongside the central projection and allow the Bank's Monetary Policy Committee to consider the implication of alternative assumptions in their monetary policy deliberations. So let me sum up with 4 conclusions. First, there is evidence that the physical effects of climate change are having an increasing impact on output and inflation over monetary policy relevant horizons. This means that monetary policy makers need to understand these risks as part of their deliberations. Second, understanding the nature of these shocks is important. While their impact will vary, these shocks may look similar to those that monetary policy makers have faced in recent years: large, unpredictable, potentially persistent supply shocks. In other words, they may increasingly present difficult output inflation trade-offs for policymakers to manage. Different central banks have different mandates, but if climate is a macro-relevant shock over the monetary policy horizon, then all central banks need to understand it. The first phase of our work in the NGFS has laid out an analytical framework and offered guidance on how to model these climate shocks. And this is also an active area of research at the Bank of England too. Third, this isn't about using monetary policy to tackle the climate transition. That is a job for government policy. At the Bank of England, our monetary policy mandate is to maintain price stability, and subject to that, to support the economic policy of the UK government. The best contribution monetary policy can make, therefore, to the climate transition is to ensure economic stability. But in order to do that, we will need to understand the impact of climate change on the economy. Fourth, and finally, governments are increasing actions to tackle climate change in order to avoid catastrophic economic damages in the future. Although the climate transition might seem like a problem for monetary policy to deal with now, delaying it will only accrue greater difficulties for the economy and for monetary policy further down the road. So as the transition progresses, the Bank of England will respond by continuing to set monetary policy to ensure that we achieve our inflation target, just as we would do with any other shock we face. I'll stop there. Thank you very much.